Good afternoon, everyone, and thank you for joining Counselor Buchanan and Mitchell for our latest professional education session. Today's presentation is entitled Investment Update and Financial Considerations for the New Year, and it's part of our Market Update series that we've been running since May of 2020. We hold these Market Update sessions every other month. Today's presenters are Debbie May and Alex Seleznev. Debbie is an Executive Vice President at Counselor Buchanan and Mitchell. She leads the firm's financial planning practice and is co-founder and Chief Investment Officer of MBI, CBM's investment advisory subsidiary. Debbie has 35 years of experience providing comprehensive financial planning and nearly 30 years providing investment advisory services. She is a certified public accountant, a certified financial planner professional, and a certified divorce financial analyst. Miss May has been recognized 9 times by Washingtonian Magazine for her financial advisory expertise throughout the Washington, D.C. metro region, including most recently as a top money expert in January 2021. Alex Seleznev is a senior advisor at CBM. He leads the firm's investment management division and is co-founder and chief operating officer of MBI. Alex is a certified financial planner and a chartered financial analyst. In addition to today's market update session, he is also scheduled to present on February 9th in a session entitled How to Choose a Financial Advisor, Strategies to Help You Make the Best Choice Possible, and on February 23rd in a presentation called Medicare and Medicaid, What Should I Know Now and in the Future? Once again, we thank you for joining us. We would ask if you could please keep your video off as a courtesy to our presenters. Thanks also to those of you who submitted questions during the registration process. Those questions have been shared with the presenters and will be handled during today's session. If you have any additional questions that come up during the next hour or so, please use the chat box and they'll be sure to respond to them towards the end of the presentation. The session is being recorded and slides will be shared with everyone attending this event. If you are attending on your phone, please email me your name and phone number so we can make sure we get you the slides. And with that, I'm going to turn this over now to Debbie and Alex.
Great. Thank you, Joe. I appreciate that. And thank you, everyone, for attending. We hope everybody is well. And we are looking forward to talking to you about 2021 as we start this year. And just to remind you, CBM does provide financial planning services and investment advisory services by the hour. Have been asked about that. We do consultations on various subjects like college, insurance, estate planning, retirement, of course. And then under MBI, which is a subsidiary, we do investment management and comprehensive financial planning. We do manage investments on a discretionary basis there, and we do include all of the financial planning services. So moving on.
Well, thank you, Debbie, and thanks again, everyone, for joining us on this crisp February day, at least, in here in Maryland. So for those of you who attended our previous webinars, usually we start our presentations, by doing something funny or showing you some kind of funny cartoon. But we thought we'd do it differently today. Of course, perhaps most of you heard about this whole situation with GameStop and other heavily shorted stocks. So we thought perhaps we should give everyone a quick update, more like a comment in terms of what's been happening over the past couple of weeks or so. So essentially, again, for some of you that are less familiar with this, you can sell you can sell stocks short, meaning you would borrow them from the brokerage that you're working with, and then the reason you would do it is if you anticipate the stock price to essentially go down, and you can actually make big money if the company that you're selling short goes bankrupt. So some of the hedge funds, specifically some individual investors as well, Melvin Capital and Citron Capital, decided to really sell a lot of GameStop shares short. It's been out there for several months at this point, but apparently one of the social media groups, let's refer to them that way, a group of this retail investors called Wall Street Bets, essentially decided to squeeze them out of their positions. And the way you would do that, you would have a lot of people buying the underlying stock so that the price begins to go up. Now, as the price begins to go up, those that sold that particular stock short have to cover their positions because they'll eventually begin to receive their margin calls from their brokerage companies. As they begin to buy, well, of course, the price begins to increase, and in many cases, it happens quite rapidly. So that is what you would refer to as a short squeeze. Now, strategy like this is not new whatsoever. That actually happens, I'm inclined to say, on a weekly basis, especially with certain small, tiny stocks, especially. But this is one of those very public events, us versus them, and perhaps that's why it received so much publicity. Now, as we speak today, by the way, for GameStop, it's trading at $93 a share. I just checked a moment ago, and dropped quite significantly from the top price of close to 400. So two comments here. Is this something that you should be participating in? And I apologize if the answer is obvious, but the answer is negative. There's no reason for you to really participate in any of this. Is this something that you should be worried about? And the answer is also most likely negative, unless perhaps you own some of those, more concentrated small cap exchange traded funds. They're not necessarily all that popular, those types of investments. Then perhaps you noticed a bump in the price of that ETF or ETFs in your portfolio, and perhaps it's been declining over the past few days. In terms of the long-term impacts, we don't necessarily see that many of them. On the regulatory side, and that's perhaps what will really spark our interest, we'll see what's going to happen. But in terms of how it would impact your portfolios now, most likely very, very limited impact. So in terms of the purpose of our webinar today, we'll talk about the market conditions. We'll talk about our thinking for the next 6 months. And of course, Debbie will share some of our top financial planning and tax strategies. So 2020 was an exceptional year. It was a historic year. It will be remembered, I would say, for decades. It was, of course, a very good year for the stock market. Large cap stocks finished the year at more than 18%. A lot of those gains came from the fourth quarter of the year, and pretty much the market fully recovered in the third quarter. Small cap stocks, interesting enough, actually outperformed large cap stocks, at least as a category, for 2020. They were up almost 20%. Essentially, all of those gains came from the fourth quarter of the year, specifically from the November rally. They were actually in the negative prior to November 3rd election. Bonds, or fixed income as measured by the Barclays Aggregate Bond Index, were up almost 7.5% for the year. And I would say it's important to note that most of those gains came from the first and second quarters of the year. Bonds were essentially flat, up 0.66% in the fourth quarter and very close to that in the third quarter. Now, in terms of emerging markets, something that we'll be covering in more detail later today, Chinese stocks, specifically, at least those that are included in the MSCI China ETF, one of the largest ETFs that pretty much anyone can buy, were up 29% for the year. And that rally actually started, in quarter of the year and pretty much continued up until today. In terms of the year-to-date results, understanding this is very short-term, so just to essentially update everyone, large cap stocks are in the positive, close to 2.5%. Small cap stocks and actually mid cap stocks continue the rally that started again post-election. They're up almost 9% for the year, and in terms of bonds, they're in the negative for the year. And that is, on the bonds, we'll talk about them more again later. But in terms of where we are today, this is not necessarily bad. In some sense, bonds are expected to either stay flat or go down when the markets are accelerating like that. Essentially, people are buying bonds, so they're selling bonds and buying stocks. And in terms of, again, Chinese companies, they're also continuing their rally, up more than 12% for the year. In terms of the sector performance, energy and healthcare are leading the way in the first month of the year. Consumer staples, which is perhaps one of the most conservative sectors out there, consumer staples and utilities, are in the negative 5.3, and then industrials are the second worst for the year. Not necessarily going to go in much detail on that because, again, it's very short term at this point. In terms of In terms of the market outlook and our perspective on that, we remain cautiously optimistic, which is where we were essentially 2 months ago when we had our previous webinar. Now, we do expect more volatility in the first and second quarters of the year, let's say over the next 5 to 6 months. There are multiple reasons why that's the case, and we actually had a couple of questions submitted to us on this prior to this webinar. If you look at the fundamentals, essentially, if you look at the valuations of different companies, especially on the growth side, they're quite elevated levels. If you look at the market sentiment, you go back to 10 months ago, March or April of last year, well, our economy was supposed to fall apart. The markets were supposed to fall apart. In some sense, people already forgot about that. It's all about this forward-looking projections that appear to be quite rosy as of today. Now, on average, essentially, regardless of what I just said, we do expect to have 2 to 3 market corrections each year. And we haven't had one since, again, March of last year. So we actually due for a correction if you just look at it from the statistical perspective. In terms of
and that would be, Alex, that would be a 10%. I mean, what would you define as a correction for this year?
That's a very good comment. So anytime the market is down by 10% or more, it's considered to be a correction. That's what it is. And again, on average, we are expecting 2 or 3 of them. In 2019, by the way, we didn't have any corrections, but we're close to that at the end of the year. And in 2018, we actually had 2 of them. So, we are due for one, I guess, at some point soon. But in terms of the vaccine, just the latest update. Of course, we get those updates daily at this point. In the United States, as of last Sunday, 30.5 million shots were, distributed. At this point, the rate is 1,350,000 each week, which is just below 200,000 each day. And as many of you know, in terms of your access to the vaccine, it really depends on where you live. I don't necessarily want to comment on any particular state or county, but it's certainly not even throughout the nation. Now, some analysts are saying that perhaps we'll hit this 70% herd immunity figure as early as middle of the summer. Not necessarily that optimistic, but perhaps closer to the end of the year, things will go back to some kind of normal. It doesn't mean that we're going to stop wearing masks. Perhaps things such as social distancing will be in place, but things such as pent-up demand, something that people keep referring to, perhaps for discretionary items such as travel, perhaps we'll see more of that in the third and fourth quarters of the year. In terms of the Georgia Senate results, understanding this is a little bit of old news at this point. So the results themselves were not necessarily all that surprising to us. I kept track of the polls, several weeks actually prior to that. Now, the way the markets reacted was somewhat surprising to us. Essentially, the rally that started in November even accelerated post the Georgia Senate results. And perhaps there are 2 major factors for that. We are now expecting a substantial fiscal expansion. Perhaps many of you heard of Mr. Biden's $1.9 trillion stimulus plan. And perhaps, given this very narrow majority at this point, we will not see any significant tax legislation until 2022. And in the second part of our webinar, Debbie will give you much more detail on that. So before we talk about the economy, this is just one of the charts that was actually published in Barron's, but apparently the source is Charles Schwab. So as many of you know, some of you already work with us, we pretty much never recommend any kind of market timing. We suggest that you essentially stay away from that. So what this research shows, it gives you essentially 4 different scenarios. If you're perfect at market timing, right, and you have a long-term horizon, in this case it's 20 years, and you invested in the very bottom of each year, $2,000 in this case, well, you'd end up with $175,000 for this 20-year period. If you simply invest immediately in the beginning of each year, it's $162,000. If you're really bad at market timing, somehow, some way, you always buy at the very top, you would end up with 141,000. Now, if you're staying in cash, as you can expect, the outcome of that would be significantly less. And notice, by the way, here, we're referring to the 30-day Treasury bills. They're currently earning nothing. Over the past 20 years, of course, they're closer to 1 or 2%. So the bottom line here, say for most retail and institutional investors, it would be somewhere between this first three scenarios. Perhaps your timing is not going to be that bad, but most likely not going to be all that perfect. But there's really not that many reasons for you to do it, assuming, again, you have this long-term horizon. So in terms of the economic conditions, perhaps as a result of the Georgia elections, we do expect a faster economic recovery in 2021, perhaps in the second or third quarters of the year instead of third and fourth, as a result of greater fiscal expansion. Plus, the Federal Reserve Bank, or specifically Mr. Powell, they gave us their latest update last week and essentially reiterated that interest rates will stay low and they'll continue to inject $120 billion into our economy on a monthly basis. In terms of the U.S. GDP, the numbers were published, let's say, a couple of weeks ago at this point, drop of 3.5%. Perhaps it will be adjusted in February, which is what normally happens the month after they announce it, which is actually the worst decline since 1946, when the GDP was down by more than 11%. For 2021, I have not seen anyone saying that it's going to be in the negative. And again, I happen to agree with that. The only difference is where you are. You're more conservative, 3.3%, or perhaps more aggressive, 6%. In terms of the Fed estimate for 2021, it's 4.3, and they tend to be a little more on the conservative side. Inflation currently at 1.4%, which is actually, quote unquote, significantly higher compared to where we were in the middle of the year, which was, essentially non-existent. The Fed's target, as perhaps many of you know, is 2%, and perhaps they'll let it go above that percentage, above that target, because they're actually looking for the average of 2%. Now, if you look at the idea of this faster economic recovery in the context of higher inflation, well, perhaps we'll see more inflation sooner rather than later. We do not believe that this is something that you should worry about too much today, but something to keep in mind, especially for those who are heavily invested in bonds. Again, we'll talk about that separately. Unemployment rates currently at 6.3%, which is significantly better compared to 14.7, which was the highest for 2020 in May of last year. And the Fed's estimate for 2021 is 5.5%, which is, by the way, very close to this frictional unemployment of 5%, or essentially full employment. Now, this is perhaps the most technical slide for our presentation today, but this is something that we pay close attention to when we actually make our investment decisions. So what you see on the left side, these are the actual returns for each asset class and for each sub-asset class for 2020. So, large cap stocks as a category were up 21%. I understand it's, by the way, higher than the S&P 500 because this is a different metric for that, but very similar. Small caps are up 16% if you use this metric. Now, notice that a lot of the gains, perhaps 3/4 of the gains for the entire market, came from the growth category. And what was at least partially surprising to us when we looked at it the last time, large growth stocks, and most of you are familiar with those names, your Microsofts, your Apple, similar types of technology and consumer discretionary stocks were up 39% for the year, but that's actually behind mid and small cap growth companies such as Roku, such as Moderna. Then you have your core or blend companies also in the large cap category. These are very popular companies such as Home Depot. Now, on the value side, essentially was flat. Well, for the category itself, it was in the negative. These are your financial institutions, major banks, many companies that essentially in finance, such as asset managers, would be an example of that. Now, when you look at the price to earnings ratios, essentially, the gains almost fully reflected in that. So for large growth, the P/E ratio is at 45. And to say it differently, essentially, investors are willing to pay $45 today for $1 of earnings in the future. In the beginning of 2020, by the way, in January of 2020, that figure was at 33. For mid and small cap growth, very similar metrics, 39 and 42, as expected, somewhere in the middle for the core blend companies. And I would say much more reasonable, at least from the fundamental perspective, on the value side. In terms of the historic average, by the way, for the market, it's somewhere between high teens to mid 20s. So again, multiple things that you can learn from this. In terms of the valuations, well, at some point they would have to be justified. Either those earnings really need to continue to go up at the same rate as they were in 2020, or perhaps that multiple will begin to go down. And usually as a result of that, the stock prices will go down as well. And also when people are making their rebalancing decisions, or perhaps they're moving some new cash into the market, this is something to pay attention to.
Yeah, and just one more comment on that, Alex, which I think is very interesting here because people have been talking about technology and large caps, and that's all they're really talking about. And if you take a look at these returns in all these different sectors, it really points out diversification is key. And as Alex pointed out, there were sometimes we were surprised by performance at different times. You can't really time exactly when that's going to happen, but the rebalancing and participation in these sectors across the board is very important. And this table, I think, excellently shows that.
That's right. So changing subjects here a little bit. We just talked about stocks. There's talk about bonds a little bit. So one of the articles I reviewed maybe 4 to 5 months ago was referring to this 40-year bond bull market. And there's a very detailed description of what that meant. And I would say this slide really gives it a quick but very good representation. So as many of you know, there is this inverse relationship between interest rates and bond prices. As interest rates go down, bond prices are expected and actually tend to go up. So if you look at the table in top left, we had one of the highest interest rates in the United States in the 80s. It was as high as 20%. And noticed over the next essentially 40 years, it continued to gradually and sometimes not so gradually decline all the way to zero, which is where we are now. If you look at the average returns, again, this is the Barclays Aggregate Bond Index for this 4 periods. Well, what do we see? For the past 40 years, it's closer to 8%. For the past 30 years, it's closer to 6%. For the past 20, it's 5% or close to that. And for the past 10, it's closer to 40%. And notice again, the more the rate dropped, the higher rate of return we actually experienced. Now, at this point, going forward, well, perhaps interest rates will decline below zero, just like it happened in Japan and Germany, or perhaps they'll stay at the same level for the next 3, 4, maybe 5 years, and then gradually begin to go up. And in that environment, what we expect our bond portfolios on average earn closer to 5 or 6%, or perhaps 2 to 3%, or even lower. And especially if you look at it in the context of potential inflation, this is certainly something that keeps us concerned. Now, for those of you who are more growth-oriented and perhaps have longer time horizons, well, we happen to like emerging markets at this point. Well, one of the reasons for that is many of them, especially Asian countries, they are expected to recover at a much faster rate than other developed companies, including the United States. One of the reasons behind that, essentially one of the main reasons, is their response to this whole COVID situation, more organized, more efficient. Now, in terms of the valuations, they've almost always been priced at lower multiples. That is not one of the reasons. But if you look at the peers, you look at certain technology or again, consumer discretionary companies that operate in that part of the world, very frequently they're sold at lower multiples. Plus, as many of those countries, transition or continue their transition from more export-based to consumer-based economies, well, those types of companies will most likely benefit from that. Now, with the outcome of the elections, perhaps the US foreign policy will be more stable. Doesn't necessarily mean it's going to be more friendly toward that part of the world, but perhaps more stable and predictable. That is usually a positive for those, again, that invest overseas. And then finally, which is perhaps a short or call it an intermediate term factor, we are expecting the US dollar to continue to weaken. Actually, one of the reasons for that is, again, we're pumping more and more cash into our economy, and weaken meaning versus foreign currencies. And when that happens, that again benefits you if you're US-based investor. So once you look at all these factors, we are quite optimistic on that part of the world. Realize, of course, they're inherently volatile. It's always been the case. It will most likely remain the case. One of the reasons why we absolutely want to be selective. We want to focus on certain parts of that of the world and not necessarily buy it in the form of an index fund. In terms of ESG, just to give some of you an update for those of you who are interested, ESG essentially socially conscious funds. There are different metrics that they use to meet that criteria, but many of them actually significantly outperformed their let's say conventional or traditional peers in 2020. So what you're looking at here, this is a report from Morningstar. 42% of ESG, or again socially conscious funds, were in the top quartile for 2020, meaning they significantly outperformed. 33% outperformed their peers in the second quartile, and only essentially 25%, 19 plus 6, underperformed their peers. Now, we track a few dozen of those funds. Like I said, we have clients who are interested in this style of investing, and I'll tell you, the majority of them have very significant allocations to technology and consumer discretionary stocks that, again, were the best performing stocks in 2020. So then we always have to ask ourselves this question: is this performance due to the ESG criteria, or is it mostly based on the sector performance? But the bottom line is, for those of you, again, who are interested, you have to be careful if you decide to go this route. So finally, in terms of our strategy, again, for the next couple of quarters, we do expect to rebalance our managed portfolios more frequently. The classic or traditional way of doing it is to go from stocks to bonds, or perhaps, if you see a correction, you would go from bonds to stocks to buy at lower prices. What we've been doing quite a bit over the past few months is to actually move between different sectors. As we talked about in one of the previous slides, there's a very significant difference between the performance of different categories, even inside of the United States. In terms of the market volatility, be prepared for it. At some point, we'll have it. You don't necessarily have to take advantage of it if you don't want to. This is something that we would prefer to do, but at the very least, be prepared. Make sure you're not caught, essentially unprepared for that. For those of you who are heavy in bonds, have a significant portion of your portfolio in bonds, well, consider your future returns from that portion of your portfolio in the context, of course, of your actual cash needs and potential inflation. Perhaps there are other options that are available, appropriate for you, such as dividend-paying stocks, such as stocks that not just paying dividends, but have a history of increasing those dividends. Multi-sector funds, actually some international stocks in developed, not emerging, but in developed nations, they tend to have higher dividend payments. So look at your options. And then finally, for those of you, again, with longer time horizon, perhaps higher risk tolerance, consider reviewing and potentially adjusting your allocation to emerging markets. And with that, I will ask Debbie to update you on our top financial planning and tax
Yeah.
ideas.
And Alex, maybe before we switch gears, you want to see if there are some questions that came in prior or in the chat box that are investment related, so we could maybe hit on those.
Yep.
So everybody has to wait till the end.
That sounds good. So we can certainly cover a few of them. So one, I guess it's at least partially related to what we just discussed. How much of our net worth should be in the market? So would you like to address this one, Debbie, or should I address it?
Sure, I can address that. Well, part of it does depend on your risk tolerance to be able to go through volatility and see the ups and downs in the market. I think for us, a lot of it is based on your time horizon, meaning how long can you leave the money in the market and not have to withdraw. We like to see people have usually 5 to 7 years of cushion in bonds as a buffer or another source of income, whether it's Social Security or pension. So time horizons really make the biggest difference when you look at the statistics of being able to wait out, corrections in the market or down markets.
Right.
Do you want to add anything, Alex?
Well, that's you pretty much addressed it. That's how we would approach this. It was a very interesting question, though. So you see, we have a method of addressing it, and then of course for each specific client, we can always adjust it on the personal preferences. But yeah, I think you addressed it pretty much entirely. The next question is perhaps a little technical. What's your view on, I guess, pros and cons on exchange traded funds, ETFs, versus mutual funds in today's market? So I guess you want me to address this question?
Yeah, go ahead.
Yeah. So with mutual funds, I mean, just to make sure everyone is on the same page, one of the major differences, there are multiple differences, but one of the major differences is that with exchange traded funds, you can trade them intraday, meaning between 9:30 a.m. and 4 p.m. You can even trade it after hours if you wanted to. With mutual funds, there's no trading involved. Essentially, when you buy into a fund, you buy it at the net asset value that is determined on a daily basis. So as long as the markets continue to cruise, let's put it that way, they continue to go up, there's essentially no difference between the two. We tend to prefer exchange traded funds on our end because we can do it on essentially on a daily basis, and we can do it when it essentially makes sense on our end. Now, if/when we see more market volatility, it is likely that for certain exchange traded funds, you'll see this so-called spread, which is exactly what we experienced in March and April of last year. And you have to be very careful about that. Why am I saying it? Let's say a fund is selling at $10 a share. The spread can be as high as 5%, sometimes even 7% to just buy or sell it. So you just have to be very careful about it. Should we take one more question?
Yeah, maybe one more. I do want to point out that I know some people have very specific questions on their portfolio that we're not going to be able to address in this format, but we're happy to have you call us. And some other people had questions about, if they're living in Maryland or Florida and this sort of thing, which I'm happy to have someone call me or email me about that kind of question, but we're not going to cover that in this particular presentation.
Sounds good. So here's one more question. In some sense, we already covered it, but perhaps we should reiterate it. In light of the stock market at/near all-time highs, when would the correction be likely? So again, we talked about this in detail. Our thinking on that is soon. I'll just give you that short answer. We are expecting it to happen 2 to 3 times each year. And given the fact that we haven't had any over the past 10 months, and again, the valuations that are at such a high level, plus the market sentiment is quite rosy at this point, essentially anything that you're looking at, we are expecting a correction soon. And I'll just leave it at that.
Right, and that directly goes to the rebalancing that people should be doing, and paying attention to that really is where your success is going to be, to try to, obviously sell when it's high and buy when it's low, and continue that process regularly, not only, but as Alex pointed out, between stocks and bonds, but also the various sectors. And when you've got this kind of volatility going on, you need to do it more frequently. Traditionally, we would maybe do it twice a year. But, when the market's like this, we could potentially do it 5 or 6 times this year, as we did in 2020.
Yeah, and by the way, just to add to that, 2020 was such an exceptional year for diversification. And the reason I'm saying that, large cap stocks and bonds, they were essentially the best performers in the first 2 quarters of the year. Second and third quarters, it was all about emerging markets that really started to rally then. And then, the fourth quarter of the year, especially post-election, mid and small cap stocks started their rally, which still continues. So like what Debbie was just referring to, it's not just between stocks and bonds. It's also between different, categories of stocks, even inside of the United States, even for the US stocks.
Right, exactly. So I'm going to move on and talk about what's going on in the predictions about the tax law that Biden is putting out there in terms of what he's interested in doing. And this is going to be very speculative. I mean, obviously not even in negotiation yet. As Alex pointed out, we're thinking 2022, maybe even 2023. There's a lot going on this year with the stimulus packages and COVID and a lot of other agenda items. And also, as you can see, as you know, there's a very narrow margin in the Senate between Democrats and Republicans. So it's going to require a lot of negotiation to get a lot of different things passed. And so I just want to put that out there before we start talking about it. I did do the acronym PRECISE for talking about the tax provisions, the major ones, and also talking about the planning around it. So the next one that's interesting to people is R, which under PRECISE is the rates of income tax. And so what are we looking at? Biden is talking about keeping the lower brackets and taxes probably the same, but in terms of the top rates, going from 37% to 39.6% if you're over $400,000 of income. So there is the looking at the bump there. I can see personally where some of this is going to happen. We have to pay for some of the stimulus that's been out there, and we have to find a way to do it. And the rates have been on the lower side as we go through this, traditionally looking back as to what tax rates had been. The next one is employment. And I call this employment because we're talking about people that are still working and they're earning over $400,000. That seems to be the magic figure again, that there would be no limit on Social Security taxes. So here's an example of where the income tax rate is only bumping up 2.6%. But here you could be looking at another 6.2% for those that are earning in excess of $400,000. So that's fairly significant, I would say. The next one is in the investment world is looking at capital gains and investment income. And if this is a threshold of $1 million, that if you're making more than $1 million and you're able to have investment income, capital gains and dividends and so forth, that you're going to be paying at the highest rate, 39.6%. Now, just to put that in context, right now it's about 20% on capital gains and dividends at that kind of income level. So you're almost talking about doubling that. And what impact that's going to have on the market and how people react, on the investment side is going to be interesting. There's other parts of the provisions about no longer allowing a like-kind exchange on real estate, and where you could continue to defer gains on real estate if you continue to reinvest and not take any of the proceeds. That's kind of on the table as well. The next one, I, is itemized deductions. And this is a little bit, I'm going to say a little bit convoluted, but it also could be a positive. And the positive is that right now we have something called the SALT, which is a state and local tax limits. And in this area, it's significant. You can only claim up to $10,000. And when you start looking at real estate taxes and what we pay in DC, Maryland, and Virginia for state income tax, that has been largely taken away. There's also limits on mortgage interest deductions, and there's a large standard deduction. So for a lot of people, they're not even claiming or itemizing deductions. So what Biden is proposing is that you could no longer have that SALT restriction, so that you can claim all of your state income taxes and real estate taxes. There would be no $10,000 limit. You could be subject to alternative minimum tax, but that was there before, and that's a different discussion. But there's also a limit if you're over, again, this $400,000 amount of income, that you'd be limited to 28% of your income if you're over $400,000. So that plays in. And there was something called the PEASE, P-E-A-S-E, which was something that Congressman from Ohio came up with, which was also another limitation on itemized deductions by 3% if your income was over another limit. So how all that's going to play together, I really don't know. But I think for most people that are under the $400,000 are going to probably benefit from more itemized deductions. The S is a small thing, the student loans. That loans that would have been in pay status, at least paying the minimum amount on the loans for at least 20 years would be forgiven. I looked up online because I was like, wow, that's a long time to wait to be forgiven. The average loan payback period for students is 21.5 years. So I'm not sure how big a deal that is. There is some pressure on the administration to do something on the forgiveness of student loans. So that's what's out there right now. And then the absolute biggest thing I'm going to say is this last E, which is estate taxes. And I was looking back at this too. You might remember in 2006, we only had $1 million exemption. So there was a lot of estate planning going on for people that had more than $1 million of inheritance, for people that would be retirement, houses, everything. And then we are now at about 11.5 million exemption. So people have sort of forgotten about estate planning largely in that regard, because for a couple, then you're over, you're talking about $23 million of an exemption. That was going to sunset, by the way, in 2026 and go back to 5 million. So that was already out there, but Biden is proposing 3.5 million. So that is going to require people to really think about their estate planning all over again if that happens. And that's 7 million for a couple, by the way, but also looking at raising the top rate from 40% to 45%, which is something, but I would think that's not really the major thing. And then this other wrinkle that comes in, which is a big one that's been out there before, and I don't know how successful this could potentially be, is no step up in basis, which simply means that after you've paid the estate taxes on what the estate's actually worth, whoever's inheriting that has to go back to what you originally paid for it. So an example would be if you had let's say you had a beach house and it was now worth $500,000, but you originally bought it for $100,000. What would happen right now is if your heirs sold it for $550,000, they're only going to pay tax on $50,000. They're only going to pay tax on selling that asset for what's over the value at your date of death. This new provision is going to take it all the way back to $100,000. So your heirs would have to pay all of the capital gains tax based on what you originally paid for it. So that's that. So those are the big pieces that are rolling around out there. And then the next precise that I came up with, and I love these pictures, by the way, this is what we call perfect timing, right?
Right.
The baby taken away by a bird and the baby being eaten by a whale. But in any case, it's plan your timing. And I know I've emphasized this before in other presentations, but you really need, in volatile times, and when you're talking about tax changes, taxes are significant even now, that you really need to be paying attention to that. And you're looking at this not only year over year, like 2021 and what's going to happen 2022. And yeah, there might be some things you can do, but what's going to happen over the rest of your lifetime? And we already know that tax laws have changed continuously over decades. So this is not the last time that something is going to happen on the tax laws. But you really want to frame your retirement. Like I always tell people, if you can look ahead and think about what your income's going to look like, what your withdrawals from retirement is going to look like, what your taxes would be then, what they're going to be now, and what tax deductions you have now and versus what they might look like later. And then even more importantly, how do you see your inheritance going to the next generation and the beneficiaries that you have on your retirement? Because there's also been changes there in terms of what people can do in terms of stretching out retirement withdrawal. So all of that comes into play. It's like a puzzle that you just have to really put the pieces together and look at it every single year to plan what are you going to do that year in the context of looking at a long-term plan for yourself. So that's what I would say there. The next one, R, in this context is retirement. and I feel very passionate about this. I think that there's very few deductions and things that you can do for yourself to reduce income taxes than put money in your own retirement account. So you're borrowing the government's money in essence when you put money in your 401k, your 403b, your IRA, your self-employed plans. You're borrowing the government's money and able to invest it, and what's sitting there is not being taxed until you start withdrawing it. So there's a lot of strategy that you can do with that. Right now, we're seeing a lot of discussion about, oh, everybody should start converting to a Roth IRA and pay all this tax for the benefit of having tax-free income. I'm not really on board with that. I'm on board with what I call hedging strategies, which is maybe you do some of that in the right circumstances. And again, if you're looking towards the next generation and you've got a lot of potential assets to get through your own retirement, because you're giving up tax money today. I mean, understand that, thinking that even if tax rates were 2 and 3% higher down the road, is that really going to make up for giving up all that investment money now? And you really have to think about it. So sometimes it's just like, maybe I'll do some of that, but definitely not go all of that. The next one is E, which is endow, which means charity. And this is also a big one that we've been looking at this past year, and I think it's even going to get bigger because with the standard deduction, people are not able to take charity deductions in essence. You know, it's potentially just no tax deduction as a result of standard deductions. If you're retired, you can do qualified charitable distributions, which means that whatever you want to give to the charity, even if it's a small amount, hundreds or $1,000, you can take it right out of your required minimum distribution from your IRA down the road, which is 70.5 now. It can be done at 70.5. Now the required minimum distribution start at age 72, but that gets them right off the top. You get the tax break, no problem. Nothing else comes into play in terms of standard deduction. The other thing that you can do, which I think is becoming more and more popular, is this donor advised fund, which is the next thing. We call it the DAF. And that's where you can put a large amount into charity. Well, I say large, but it could even be $5,000. It could be some amount that gets invested in a fund and you sprinkle it out in later years. That deduction on this return happens the year you put the money in. So that can take you over the standard deduction and get you some tax break. And you still control the money and you can still give away a $50 charity amount, a $100 charity amount. It's super simple. I can tell you that. So, and then the last thing is really appreciated assets when you're doing charity. So you look at those low cost basis stocks or assets, and then you give that to the charity so you can avoid the capital gain. The charity's not going to pay a capital gains tax. So that's the better of the choices in terms of, a low basis stock versus cash. So that's what I want to say there. And I think we're even going to see more at the larger level of contributions where people are looking at charitable trusts, where they get an estate tax benefit if that happens, and they need that. Plus, they can have some control over still having the income during their lifetime. But that's a little bit more complicated, larger donation type situation, I would say. The next one is college. And I just like to remind people that, again, we're looking for vehicles out there to save people tax money. That's what we're talking about, and still have control and still have growth and be able to use it for a lot of different reasons in some cases, like the 529 plans. So even for clients that don't have a 529 plan and they're paying for college, they can open one up, get a state tax deduction. This is not a federal tax deduction, and pay for the tuition and get some benefit there. And in our states around here, it can be from 6 to 8.5%. The other thing is that if you're doing it obviously longer term, you could even set it up for yourself. For example, I have one that's set up for myself. I'm not planning on going back to college, but I am planning on having money potentially for my grandchildren, which I don't have yet. So I can be putting in the money now, having it grow, keep this in mind, potentially tax-free, and I can then have it change the beneficiary later on to a grandchild or to someone else. And that's building up the money much sooner than if I just waited until the grandchild comes. The other thing, this is a smaller thing, is the Uniform Gift to Minors Act, where you would have an account that's actually set up, a custodial account for your child. You're still able to do that and have about $2,200 a year of income that comes into that account that's tax-free. And that's called the kiddie tax rule. So it's about $2,200 a year. And for some people, that could be investing at 6%. They might have $30,000, and they can use that for any purpose for the child down the road, including summer camps or whatever it might be. So that's out there. And then the Roth IRAs, and this is an interesting story because people forget that even if your child is working part-time in high school and college and earning a few $1,000s, they're eligible to put that up to that few $1,000s into a Roth IRA, also growing tax-free. But a Roth IRA, especially for a younger person, is like a bank account. You know, you can use it for college, you can use it for first-time home buying, you can use it for like 9 reasons that don't involve being retired and don't involve a penalty, and in some cases not even tax. And I had a client that I just talked to yesterday that said she had been doing that, you know, per our advice for, you know, 8 or 9 years, and now her daughter has like almost $40,000 in a Roth IRA to start her career. Didn't seem like a lot at the time, but it did build up. The next one is I, which is the IRAs. And I've touched on this a little bit, but Roth Conversions, a lot of discussion I see out there about that, but I think really needs to be analyzed in terms of what that makes sense with taxes in your own situation going forward. The idea of a Roth is great. It's growing tax-free, and you have tax-free money down the road. But if you do it to some huge degree, you could even be in a negative tax bracket down the road and not even really see that benefit because you don't have a lot of other taxable income. The other thing is that, as I said, you're paying the taxes now, so someone needs to do that analysis of the growth on that money and what you've given up. Backdoor Roth, that's been around for a while, and with that, everyone that's still working that has an IRA account and has also been trying to, you know, put money in on an after-tax basis, a non-deductible IRA should be looking at this, especially if you're close to retirement. It's a way to move that money into a employer-type plan, which you'll get back to your IRA later, and convert what you've been doing in a non-deductible IRA to a Roth IRA, because the income limits are pretty low in terms of when you're actually eligible to donate, to contribute to a Roth. So that's just a very simple plan. I'm actually surprised it hasn't changed at this point, or hasn't been, you know, the loophole hasn't been closed, but it's still out there. And then you can contribute now, this is a tax law change, beyond 70 and a half. So if you're still working at 70 and a half or beyond, it used to be you couldn't any longer contribute to an IRA, it didn't matter, but now you can. So as long as you're working, you can still continue to contribute. And as I mentioned, non-deductible IRAs, I would say, have not been utilized to the extent that they should be. And an IRA contribution right now is $7,000. If you're over age 50, it doesn't seem, again, like a lot of money, but you're putting something into an account that's growing tax deferred. You're not going to pay tax on that every single year until you start making the withdrawals, and that can be, you're not even going to be taxed on all of it because some of it you didn't get a deduction for. So it's kind of like a middle of the road Roth IRA in a way, and also has, you know, positive tax situation along the way, as I mentioned. S is Social Security, and I'm not going to get into this. We just did a webinar. Actually, Alex and my partner Judy Barnhart did a very well received Social Security strategy webinar last week, I think it was, right?
That's right. It was just last week, yeah.
You know, there's a lot of different strategies and individual circumstances, but if you would like to, if you weren't a participant in that and you'd like to get those slides, email either Alex or I, and we can make that happen. But
Absolutely.
People need to understand that Social Security has an impact on your taxes. For most people, it's 85% taxable. And that could impact your medical deduction. It could also impact some of these other scenarios of, are you going to be over a certain threshold of income, and other things start to happen. Also, the when to start, because understanding you're giving up money if you don't start sooner, but there is an impact of getting more money if you wait till age 70. And just understanding all those rules, this is a huge area, especially as you're getting close to retirement, right? We're not really looking at this in, younger work years, but we're looking at it as you get closer to retirement and what makes sense. And you're looking at it every year. And with couples, there's even some strategies for them. And the last E, as I mentioned, is estate planning. I just talked about the other E in the tax law, the state taxes. I think this is going to be huge. Understand that there is a no-brainer every year that you can give up to $15,000 without any gift tax returns, without any tax to the other person. It's an exclusion. And with couples, that can be $30,000 per person, for grandchildren, for children, whoever it might be, for relatives, any individual. And that gets the money out of your estate. And then they can grow the asset, in their estate. That seems, again, like a small thing, but it's one, again, those kind of no-brainers that you'd want to take advantage of year to year. Holding on to low basis stocks and investments generally makes sense unless this whole no more step up in basis occurs. Yeah. Because if you die with those assets, your heirs are going to inherit them at that value, and no one's paid the capital gains tax from selling it. So that can make sense. Or, as I mentioned, you're giving those to charity. So you're going to say those things are going to go to charity, or I'm going to have a retirement account beneficiary, or in part a charity. And looking at the beneficiary designations on who are on your retirement accounts and your life insurance, I know a lot of clients are not even sure, or they haven't changed it or looked at it in a decade. And you want to, with the tax law changes that are already out there, you want to be looking at this annually. Make sure you know who the beneficiaries are and if those should be changed, because that has income tax planning, estate tax planning, and generational planning that can be huge. And with that, I think that concludes my comments. And I don't know if we have other questions, Alex, that we want to touch on. I think we have a few more minutes.
That's right. Yes, let's cover a couple of questions that came prior to this webinar. And again, for those of you who are participating, we already have one question from the chat box. Feel free to, again, to type your questions and we'll do our best to address them. So here's one. We sold our house but remain in Maryland as of now. We also purchased a villa in Florida. How do I decide if we do Florida residence and save on taxes or wait longer? What do you think, Debbie?
Well, I think, again, that question really depends on domicile and facts and circumstances about where you're a resident of. And that particular question, whoever asked that question, please feel free to reach out to me by email and I'll try to address with you one-on-one.
Sounds good. So here's actually, let's take this one from the chat box. What is your take on cryptocurrencies? There's very, very many of them at this point. Prospects and investment potential. So it's interesting. I had several conversations on the subject with other investment professionals, not necessarily our existing clients, and your opinion about it would depend entirely on the prospects. There's very few people, I would say, who are in the middle. Some people are really for it. They really believe in it. Other people are not so much. From our perspective at this point, it simply wouldn't match, the investment criteria or preferences for many of our clients. So we're not necessarily focusing on that at this point. I am going to go ahead and say, and I think the last time I actually had a presentation on this was maybe 3 years ago at this point, it is here to stay. I do not believe that cryptocurrencies will just disappear at this point. I do not believe it's a fad. And for those of you who are more technically inclined, I'll give you this answer by Ray Dalio. He actually gave his opinion on that. Think of it as a long-term call on something where you would be willing to lose something like 80% of your investment. But if you win, well, of course, you can walk away with much more than that. But at least on our end, this is not something that we're focusing on. All right. Any other questions from the chat box? All right, well, if that's the case, again, if you have any questions about anything we discussed today, feel free to reach out to Debbie or myself. Here's the contact information on the slide. We very much appreciate you joining us today. And again, we'll be doing this updates every couple of months or so. So
Right.
we'll do our best to keep everyone updated.
Yeah, and I think if you go onto the website, you can see other webinars that are happening in our firm.
Actually, it is here. I believe Joe
Yeah,
mentioned that
okay.
earlier, but we
Yeah.
will have actually a few of them, maybe even several,
Yeah.
over the next few months
Yeah.
or so.
And on the Medicare one too, that will be a co-presentation with an attorney that specializes in Medicaid planning. So I think it's going to be very interesting. Okay, thank you, everyone.
All right, thank you.
All right, take care. Bye.